everyone, this is a trader investor coming to you on Thursday, July 8th, 2021, and I am starting off with the broader markets. As you can see on the screen, it is gapping down very significantly. Could you have anticipated this move? If you were bullish, were you protecting your position? And I'll tell you a couple of reasons why I participated in this and made over 520% gain in my put positions. And it's not because I can tell the future, it's because I just let the charts tell me what to do next, and accordingly I take a position. Sometimes you take a position and it's wrong. That's why you have tight stops. That's why you manage your risks and you don't load up the boat with every position just because the technical seems like, wow, this is great, right? I mean, hindsight, I could say, well, I should have bought more, but that's not how I trade. I don't regret my position size. Regret is not my game. I take positions based on my account size, based on my risk tolerance, and then let the charts play out. So over the last few weeks, or about few straight 7 days, the SPYs just kept driving up, and then in the last 2 days prior to today, they were kind of getting weak. And in this weakness, what I saw is a divergence in my oscillator. What I mean by divergence is as price moves in this direction, the divergence happens when the oscillator moves in the opposite direction. So when I saw that, and I saw that, last couple of days we were struggling to push up one way or push down one way. It kind of starts off high and then pushes down. Starts off high, pushes down. And also at the same time, as price pushes down, it reverses back up. As price pushes down, it reverses back up. This to me is a sign of indecision, a sign of weakness in the broader market, a sign of trust in the broader market. And if we look at the daily chart just for a moment, as you can see, you get some hammers. Up, down, reverse back up, up, down, reverse back up, and you get some hammers. So when you're getting this kind of action and there's a divergence, it is easy for put position, or if it's the other way around, for a call position to be taken overnight, right? This is not a position you take this morning. This is a position you take yesterday, right before the close of the market, to take advantage of this move down. There was something similar that I did, I think it was on the 18th. Yes, absolutely. Same concept here, when price is struggling to decide what it wants to do, and as price was driving higher, but there was a divergence here in the oscillator. As price was driving higher, this is where I was able to take advantage of this. I did not just say, hey, price drive higher, let me get in, even though hindsight this could have been a great play, but I wanted to see price higher, weakness, take a position. Again, very beautiful entry here and exit here, and I exit right at the open. There's no reason to want to go for more because markets could have a tendency to reverse. And I draw this Fibonacci, and my exit is somewhere between the 1.272% extension or the 1.618% extension. So based on this, if markets open anywhere in this region, I'm out, right? And on the 18th, they open somewhere in between, and I'm done, right? And actually, the open on the 18th, as you can see, is right at the 1.618% extension. So similarly today, price went up, price kept going up, and then weakness, down, up, weakness. So I drew Fibonacci retracement from the last swing low to the highs, and my exit again is between the 1.272% extension and the 1.618% extension. So somewhere in between. And where did price open? It opened way below that. It tagged it and came back down. Now here, as you saw in the 18s, price didn't stay up here. It kind of went down a little bit, but then it wants to close back this gap. Today's activity, even though they always give us a reason, right? Oh, it's the Delta variant of COVID, that people are worried about the unemployment rate that has ticked up, blah, blah, blah. Look at the technicals. The technicals are already preparing for that action. That's what I'm looking at. The technicals are already preparing for that action, and boom, it goes there. Now, what could happen? We can take out the fib extension and draw our imbalance. I want to be very picky and just draw it precisely on a straight line. I don't like it when it's not a straight line. I'm just a little picky like that. And there you go. And we have this imbalance. There's a big gap here. And if you measure that imbalance gap, is $4.41. So what could happen? There are a couple of possibilities here where price would break out of the 15-minute range high and try to at least go halfway to this imbalance. And that halfway, where does it line up with? It lines up with the low of yesterday. This is how things line up beautifully. That low of yesterday, what does it line up with? The mid-range of Friday. All of these things always line up. And you might say, why is there a turning point? Because there was a 15-minute range somewhere that is acting as support resistance. That's where turning points occur. They can blow through it, but that's where turning points occur. So in this instance, we could stair step into this, then just continue to go up, or we could stair step into it and then collapse. Either way, we just prepare and trade what we see. We're not in any hurry to enter the direction. Now on the entry side, another Fibonacci I will draw for you is from the high of yesterday's 15-minute bar to the low of the first 15-minute bar of today. We would probably see a 50% retracement. Not necessary, but again, that lines up very closely to the low of yesterday, which lines up with the mid-range of Friday, of the 15-minute range. And so this is possibilities. Then the 618% retracement is actually very close to this imbalance midpoint. So that could be also another area of reversal. This is what I want to look at, right? This is what I want to see as price drives up here and gets rejected. Boom, another put entry to target at least the 15-minute range high or the lows, right? It could be that by tomorrow we're going down some more. Today is only Thursday, so we still have one more trading day for the week. So that's a possibility. We trade what we see, not what we want. So be very careful right now. I have already taken a significant amount of gains here. I don't want to give it back by entering just because I'm trigger happy. I want to see what the markets will do. I want to let the markets tell me what they want to do. And if I switch to an hourly view, as you can see, there's some strong support area here. This is where price is kind of holding on to that support area. There's more down here. So if you can just keep drawing your support, you'll see this is where price could potentially stall and then reverse back to the upside. So broader market, this is how they're setting up. All of them are setting up the same way. You have this big gap down, but price is now stabilizing. IWM, I've mentioned to you many times, is my leading indicator, and IWM has already given us this down move. This is another reason why I was so confident to say, hey, this down move continues. I'm going to enter a put position in the SPYs. I saw the divergence. I saw my leading indicator going down. Boom, I can enter that position with confidence. And if I'm wrong, I'm wrong, right? So, but the idea is consistently having this analysis in place so that you can enter them. And don't just let it work one time, doesn't work the next time, and you abandon the strategy. You stick to the plan, because over a long term, they just keep working out. The reason why many people do not succeed is because it works 1, 2, 3 times, it fails, they abandon it. It doesn't work the first time, they abandon it. It doesn't work the first time, it works the second time, it doesn't work the third time, they abandon it, because they say, well, this is only 30% success rate. Well, only 33% because you tried it 3 times. If you try it 10 times, it might be a better success rate. If you have to try something about 20-25 times to really understand the success rate. So you can do it small. By small, I mean you can even do shares. You can do 1 share 25 times, right? You see a signal, you take 1 share. You see a signal, you take 1 share. You journal your entries, your exits, your whys, and when it works out, why it worked out, when it didn't work out, why it didn't work out. Then after about 20-25 tries, you can say, well, this strategy works, I can continue. This strategy doesn't work, and here's the reason why, because you've journaled your entries, and based on that you adjust your strategy and move on. By doing just 1 share, you are minimizing your loss, but you are learning. Instead of paper trading, I like to do it this way, just risk real dollars. Then my emotions are at play. Paper trading, my emotions are not at play. Paper trading for me is just to refine a strategy, is not to refine my emotions. The only way I can control my emotions is to have real money at play and then make decisions based on that real money at play. So another thing I want to show you, I will switch back to the daily and not really focus up here, but focus on the sentiments. My sentiments, there are 2 things that I am concerned with. The VVIX, which is the volatility of the VIX itself, and the VIX has really spiked up today, and the put-call ratio. Put-call ratio says more puts are being bought than calls today. Right, every dot that you see here represents 1 day. So the more puts are being bought and that put call ratio rises above 1, it means from a sentiment point of view, the market is concerned. The market is positioning to protect accounts, buying lots of puts, or to buy puts to ride the wave down, right? Take advantage of the trend down. So if you're looking at it from that perspective, the put call ratio is really driving close to a 1. It is at 0.97, close enough to a 1. The VVIX is above 120, and the VVIX above 110, I'm already concerned. Above 120, which both of them were yellow in my indicator. Yellow means very cautionary area. Above 0.8 in the put call ratio, above 110 in VVIX. They tell me, well, be cautious, and if one of them turn red, it's time to go. Well, this is where we took advantage of the SPYs yesterday. Price was driving up, yes, but We had yellow in put call ratio yesterday. We had yellow in VVIX. What do? We buy a put. And now on the daily, there was no divergence, right? So the daily divergence is not yet coming. However, the smaller time frames, they react quicker, right? So that's why I use 15 minutes, 30 minutes, an hour time frame. If I see divergence there and I see some of the sentiments and I hear chatter in various news outlets, hey, we're worried, I know people are going to load up on puts. And what does that do? Bam. One more thing I will tell you. Another great buying opportunity for my long-term accounts. When I see a significant move like this, I sell covered puts. And I have an options 101 course you can go over, but covered puts means at a certain strike price, I want to buy that ETF, that stock. So if I want to buy SPYs, if I want to add SPYs to my long-term position because I'm long-term bullish in the US market, instead of buying it at 434, I wait for price to come down, to have this gap down, to have a gap down. The reason why I wait for that is the put options become pricier, there will be volatility, and they become more expensive. And as they're more expensive, I sell them, I capture premium. If price reverses like it did here, if it reverses 1, 2, 3 days quickly up, those volatility comes down. I'll show you exactly what I mean. If you look at the VVIX here on this day, just follow this white line down. The VVIX is red, put call ratio is yellow. The next day, same thing, but the value is starting to drop. The next day, it drops even more, and the put call ratio is now under my warning threshold. Following day, they are both very well below their highs. Then you can buy back those options because the price of the option is much smaller, and because price has gone in your favor, meaning bullish in this instance, those covered puts that you sold are much cheaper, and you can get out of that position for 20, 30, 40, 50% return on your risk. This is beautiful play. And if not, if price keeps going down, I'm okay to own the stocks. That's how I buy my positions. Instead of buying up here and say, hey, it's long term, I don't care. Well, let me collect some premium. Let somebody pay me $500, $600, $700 per 100 shares. And then if price continues to go down, I will buy it at 420. I was about to buy it at 425 anyway. I'll buy it at 420 and my cost is 413 because of the 700 that I collected. And then I wait for 5, 10, 15, 20 years for price to go back up. So I just wanted to add this bonus for you so that you can see how I am positioning myself for my long-term holds. So real quick, coming back to the SPYs on the 15 minutes, the range is intact. When the range is intact, just be patient. Be patient because right now it's telling you, I don't know if I want to close this. I don't know if I want to go this. I don't know. That's what it's saying. So wait for it to break, give you a retest, and boom, you can target the 50% retracement, yesterday's low, the mid of the imbalance. You can target any of these. And if price is strong on the way up, you can target it all the way to the 78.6% retracement. But as price passes the 50% retracement, just have tighter stops. And your stops could be from level to level on the Fibonacci retracement. And if you get a strong move, you don't have to exit your last position. You exit your 50% position, 25% position as price moves up, and the last 25% you can keep riding it until you get stopped out. Alright everyone, I know this has been a long video, but I just wanted to go over some of the strategies for you. Take care, and I'll see you in the next one.